Everybody to today's presentation on SMSF expenses. I'd like to introduce next to me Ben Clayle, who's one of our client managers here. Welcome, Ben, to today's presentation.
Thank you, Tim. Afternoon, everyone.
I invited Ben basically because I felt that his surname rhymed the most with our topic today of NALE, and no one really knows how to pronounce it. And sort of NALE almost is a little bit Spanish, and we all get a bit excited when we say it. It's a little bit too close to NALE, but we'll kind of remember it or reference it as NALE or NALE or NAIL today. We'll just go with a little bit random. So, but welcome to today's presentation. What I am going to speak to you about today is particularly in regards to SMSF expenses and how those SMSF expenses are impacted with the introduction of the non-arm's length income rules. So what I will do is, of course, the disclaimer is an interesting one today. As you know, I generally will run through that relatively quickly or skip through it. But of course, we are waiting with anticipation on the tax office to finalise the LCR in relation to non-arm's length expenses. And I know there was a presentation delivered at one of the recent SMSF days by a representative from the ATO, and the word is that it's not too far away. And I also caught up with a colleague from the Chartered Accountants last week, and they have also caught wind of some upcoming releases in regards to it. So hopefully we can see something in respect of the non-arm's length expenses in the sort of immediate short term that can hopefully at least put our minds at ease as to what the position is, regardless of whether it's a good position or a bad position. We will see where we're at. So today is to me, I wanted to look at identifying what were some of the key issues associated with non-arm's length expenses, and particularly not to get too caught up in the way that the legislation is worded and all those sorts of other issues, but really look at the peripherals. And whilst I will talk through some of the issues around the non-arm's length expenses, I really want to address, I guess, what are decades-old practices in the SMSF industry and how those practices are effectively impacted immediately. So in effect, they're impacted since the 1st of July 2018. So we need to be on top of our game with regards to it. So I will touch on this whole idea of individual versus trustee from an activities point of view. And in doing that, I will sort of try to highlight the key industry groups that I think are targeted with reference to general, but also more specific style sort of expenses, and see what we need to contemplate there. The trustee remuneration and the contribution rules, that's probably the second half of the presentation. That's what I want to focus on with a little bit more depth, because, you know, off-market transfers for all of us, for example, is a fairly significant issue. And I'm expecting that many of you have actually read the technical bulletin or glanced over the tech bulletin I did last week. When we send out the CPD, you'll get another link to that. But I'll also, just for reference, I'll send out, I prepared a paper on this non-arm's length expenses early in the year when I did a presentation for the Tax Institute. And so what I've done is I am in the middle of, or 3/4 of the way through, updating that paper based on today's presentation. So when we see you through the CPD, a lot of the definitions, you'll get a copy of the slides, but a lot of the definitions that I'll sort of gloss over a little bit today will be incorporated into that paper. So hopefully it's a bit of a useful document for you to move forward and use as a bit of a reference guide. So that whole trustee remuneration and contribution is a key part of today's presentation. That's, of course, linked to property valuations and more, I guess, aligned or akin to off-market transfers and other things where we're trying to transfer properties in or shares in, and what valuations are we using. I guess the importance, particularly as we come out of COVID-19, and let's hope we come out of COVID-19 sort of in the short to medium term with vaccinations and other things. But as we see some form of return to normality from a operating a business, from normal commercial properties. I know here in South Australia we've had a removal of the work from home order, or the concept of work from home as of this week. So, you know, we're starting to see the CBD fill up a little bit more, albeit that we're now running to Christmas and New Year, which is traditionally a quieter period. But, you know, post-January, are we going to see the CBDs around the country filling up a little bit more, and therefore rents and other things returning to normal? And what's the impact that's going to have on property valuation? So all of that becomes a broader and bigger picture that we need to take into consideration moving forward for our clients. And of course, for me, this all gets captured in this concept of dealing with related parties. What are the traps? What's going to catch us out? Particularly if we've operated in a way that has been, I guess, commonplace to us for many years. And the examples that I often raise in these presentations, you know, many of them do relate back to 2007 when super reform came in, and that's when we saw a lot of our non-arm's length income changes, or our first sort of move across to the new Income Tax Act. And, you know, it's crazy to think that that's 13 years ago now. And that's 13 years since the introduction of limited recourse borrowing arrangements, and we're still talking about matters that are impacted by limited recourse borrowing arrangements. And I think in many respects, a lot of these non-arm's length expense issues come directly from LRBAs. So, you know, if we identify some of the key messages around arm's length transactions, the first place we always look at is the SIS Act from a compliance point of view. And so, you know, we always go with, well, what do the ATO say? What does the legislation say? What do others say in regards to arm's length? And the key thing is that whole concept of, you know, would a prudent person enter into such a transaction? Now, this whole idea of what a prudent person would do and what somebody acting in the best interests of others would do, you know, whilst it's not a part of today's presentation or a natural part of today's presentation, you know, the introduction of this Your Future, Your Super mechanism that the government announced in the federal budget, and the release, what was it, 2 weeks ago, of consultative legislation that talked about the trustee covenants for self-managed super funds and other funds being updated to say that the trustees must act in the best financial interest of the beneficiaries of the fund. Now, that, in many respects, what they were doing there is expanding the definition of trustees must act in the best interest of beneficiaries, to ensure that when you are undertaking any transactions for the funds from an expense point of view and from an investment point of view, you know, have the trustees considered all options. So whilst we're dealing with related party transactions here, you know, are the expenses associated with related parties, are they in the best interest of the fund, or is it in our best interest to go elsewhere? And that's something that we're going to have to really think about once this best financial interest comes in, because whilst it's only a covenant, it's obviously going to have a greater impact on the way our investment strategies are managed and the overall operation of the fund. So investments obviously must be made on a strict commercial basis, and I suspect that ultimately it's because we've seen a variance of what people consider commercial is why we've got to where we are these days. Income from assets must reflect market expectations. I've always found that to be a pretty interesting one, just from a general commentary point of view, and it's a lot to ask of fund administrators, fund accountants, and fund auditors to determine in a commercial transaction entered between two parties whether the rents are commercial. And so, you know, would this mean that there is a greater emphasis on rental valuations being provided as far as property valuations? And, you know, I mean, Ben, that'd be an area that, as an administrator, you obviously get a lot of property valuations for the properties that you manage. Do you see a lot of rental valuations coming in with these properties, or do you often just see the lease arrangement sent through?
There's a bit of a mixture. I think as we're educating our clients more and more, like, we're wanting valuations to substantiate what they are, because the auditors requesting it. So
yeah, and I think that's the big key, isn't it? With particularly now with such an emphasis on fund auditors as well, and the job that they're going to do, the relationship between fund administrators and fund auditors is so critical in almost rather than trying to second guess what the auditor might require, at least having that information up front, so that the communication between ourselves and the clients is at least addressing the issues that we know the auditor is going to want to at least ask for, particularly if you're dealing in related party transactions. So look, it's good to hear that we do, or we are starting to see a few more of these sorts of things form part of standard practices. And that obviously links into the independent valuations as well. And the last point being that transactions are no more favourable to related parties than they are to the general market. And I'm going to come back to that concept a little bit later, because this is one of those areas where I see such a discrepancy between, say, the SIS Act and the Tax Act particularly, and then the way we operate, and we take a compliance first approach. So as SMSF administrators, but also individually as SMSF trustees, our first thought process should be about SIS compliance rather than tax ramifications of transactions. And so whilst tax is a key part of our planning, we need to make sure that we are complying with the SIS legislation first and foremost, to ensure that we maintain our compliance status to at least enable us or to entitle us to that concessional tax rate. And I think that's pretty critical in the whole process. So look, very quickly, what is the purpose of NALI? Well, I want to draw everyone's attention to the original intent that came back for the 1936 Act, which was designed to prevent income from being unduly diverted into superannuation entities as a means of sheltering that income from the normal rates of tax applying to other entities, particularly the marginal rates applying to individual taxpayers. So, that's at the basis of this conversation and the basis of some of the things that I'm going to discuss with you today. That sentence still rings true into what are the objectives of any introductory measures around non-arm's length income is, are people trying to divert income into their self-managed super fund to obtain a better tax rate? And look, I like to make sure that I chuck in a fair amount of my own opinion in these sorts of presentations to balance out the other, I guess, factual information provided by regulators, the Treasury and other parties. And, I still struggle with the concept of these non-arm's length expense changes and the direction that the LCR have taken as really covering off that point there. I see the original intent of it absolutely being targeting those non-arm's length provisions, but then where we've landed and where I guess we expect to land post the finalisation of the ruling is that we're a little bit far removed from that original purpose of non-arm's length income, and that's to me a little bit troubling. But it means that we have to change our communication message, and that's obviously a part of what we can talk to you about today. So if we touch on the legislation, again, as I said, I will provide you with the full text of the legislation, but ultimately the key messages that we need is that we're talking about parties to a scheme, and the definition of a scheme pretty much incorporates any sort of transaction where there's a plan, a scheme, a proposal, a transaction. Anything that we enter into is covered by that scheme, where the income is more than is expected to be derived if we were dealing at arm's length. So obviously, if we get more income than we would naturally expect, then it's going to be non-arm's length income. But then we've got the 2018 changes, and if the trustees incur a loss, outgoing or expenditure that's less than what we would expect if we're dealing at arm's length, then the resulting income of the fund will be non-arm's length income, and that includes if we don't incur an expense. And I think this is the critical thing, is that we've gone from this position of saying, okay, is the income relevant? Is the income too high? And so there was this kind of concept when the legislation came in saying, well, the non-arm's length income does cover off on the income issues, and if we're attracting too much. But then really what the emphasis of this law change was to say, well, are you getting too much income because your expenses are underinflated or non-existent, and therefore you are actually bringing in more than you would expect in a commercial basis. And so, to introduce this expense change from 2018 is obviously significant, and I'll touch on the hows and whys and that in a moment when we get there. And of course, it's incorporating our capital expenses. So the acquisition costs associated with transactions, and many of those are the issues that I think have been caught up fairly significantly within this this transaction are things that we need to be mindful of. But look, I wanted to remind you all though that non-arm's length income also applies to private company dividends and to discretionary trust distributions. And of course, with our private company dividends, we've got a lot of old law and old test cases, court cases that touch on those company dividends, and you know, they look at the value of the shares. Did you pay unders for it because it was a unlisted company, you're an employee there? We still see a lot of employee share schemes, and that's probably, to me, where our private company dividends become an issue. But these new gnarly expense issues associated with employee share schemes has probably been a little bit undersold at the moment as well, in that if you are not paying anything for an employee share scheme and then those shares vest and all of a sudden the value is enhanced, then is it automatically non-arm's length income? And you know, if we're talking about revenue from a tax office point of view, I would think there straight away is a clear catch-all provision that we need to be mindful of with things like employee share schemes. But discretionary trust distributions is clearly another key issue. And as those law changes came in, it also talked about the expenditure, obviously, of a fixed trust entitlement. And so most of our fixed trust investments in the SMSF space, you know, if everything else is done on an arm's length basis, then we don't have any non-arm's length considerations. But if we've got discretionary trusts that a self-managed super fund may invest in, then we can have issues that are raised. Now, I know that as I work with all the client managers here, I get various issues raised to me and people throw different questions and concepts behind me. I know we had one that came up this year, Ben, that you and I spent a bit of time on. If you can just sort of run through the basis of that, and I can maybe pose some questions to you about why non-arm's length income was relevant.
Yeah, sure. So basically, we had a client who was one of a number of specialists in a medical practice.
Yep.
And at the start of the year, their SMSF acquired units in that unit trust, which owned the business premises, which is okay.
Yep.
And then going forward, like the trust made regular distributions throughout the year to the SMSF, so a full year of distributions. But on reflection, looking at them at year end, you know, they seem quite high, particularly when you factor in the lease of the property.
Yep.
And obviously, the client, had said at the beginning of the year they'd sought advice elsewhere, and it was all legit, above board, et cetera. But you know,
always is.
Upon further investigation into it, the income was being distributed from the trust, distributed to the unit holders based on fees charged by each specialist, and so the fund received like 80,000 income for the year when they only paid a couple grand for the units.
Right. Okay. So, so I know the conversation we had about it. We were pretty comfortable that it was non-arm's length income because it was the income wasn't based on the unit holdings, because the unit holdings was relatively small proportionally across all of the unit holders within the fund. So how do we treat the income? How do we deal with the trustee in that regard?
Yeah, so we had to have a chat with them and further dig into that, and then basically, it was decided that we needed to treat it as on an arm's length income. So treating it in the tax return as taxed at 45%.
Right. The client happy about that, no doubt.
Yeah, not overly, but obviously, there's a reflection on the advice that they'd received. But yeah, you just got to be careful getting advice and not just taking it for granted.
Yeah. Okay. So then, just to finalise that point, then what have we done? Because presumably the self-managed super fund still owns those units in the trust.
No. So that was the other option. That was the other item as well. So they needed to get rid of those units as quickly as possible. So they sold them at arm's length to another entity that client owned, which is where it should have been in the first place.
Yeah. Cool. Look, and I think that's a key thing. I mean, we're talking 2020 here. So even though the discretionary trust concept has actually been around ultimately forever and a day, pre-2007 even, that distributions used to be called special income. The fact that people are still trying to set up arrangements where they're trying to move income into the self-managed super fund, on a non-arm, or that would otherwise be considered non-arm's length. It represents that the industry still is not, 100% switched on to the practices that they should be engaging with SMSF trustees. And that point, that original EM point about money sort of flooding in to a lower tax environment, is what they're trying to avoid. So, good one to pick up, nasty one to cop from a tax point of view, but to be able to resolve it in a relatively short time would have been nicer, obviously, if we had full disclosure up front that maybe we could have even reduced the number of distributions that have been received. But you can only ask so many questions, and see how we go. So look, yeah, good position to end up in there. So look, I guess that gives me, or leads me into the key events for non-arm's length expenses, and what that actually means from where we started to where we've got to now. And I go back, the first one I'll put in there is the TR 2006/7, which is the special income ruling, which deals very much so in that discretionary trust and private company set of rules, and outlines a lot of circumstances. And of course, that was also written under the 1936 Act before the super reforms came in 2007, resulting in a move from the 36 Act to the 97 Act from a tax act point of view. But then there were the key events to me, which were around the introduction of, firstly, Section 67(4)A back in 2007, limited recourse borrowing arrangements, or instalment warrants as they were at the time, and then Section 67A and 67B, which was the introduction of our limited recourse borrowing in 2010. And there were some fairly significant documents that were released around those limited recourse borrowing arrangements that started to come into effect from 2010 onwards. To me, it was a little bit problematic that we had ATO-ID come out at 2010, 162 come out in 2010, and then we had PCG 2016-5 and tax determination 2016-16 in 6 years later. Now, the reason I highlight that is because ATO-ID 2010-162 was the one to do with low interest rate loans, and the ATO basically said, from a SIS point of view, this is not a problem. And that was the issue, is that it was only really dealing with a SIS point of view. Whereas we then saw private rulings, we saw interpretive decisions and other things around the income associated with those, and that's what led to the PCG and the tax determination 2016. I'm going to touch a little bit on those in a moment. But those three events, to me, shape the non-arm's length expense measures that came in 2018, and particularly when you start to go through a lot of the Treasury consultation period and things like that, it was really geared around this charging lower than expected interest rates on limited recourse borrowing arrangements and fixing those sorts of things up. But these other two issues here that I've highlighted, the tax ruling 2010-1, basically defining what a contribution is, and SMSF ruling 2010-1, acquiring assets from related parties. Those two documents themselves, to me, they forecast, or they set in some form of concrete, and well, I think many of us felt they were concrete at the time, practices that we all needed to adhere to in the SMSF environment to make sure that our clients satisfied their compliance obligation with regards to what the ATO would deem a contribution, right? And also what we could and couldn't acquire from related parties, but also how the provision of a service, a related party service, would be treated in the SMSF space. And so I'm going to come back and talk about those in a moment, because to me, the key issue here is that the LCR 2019 D3, which talks about the non-arm's length expense, it really almost forgoes the whole concept of limited recourse borrowing arrangements from an interpretive document, because we've got all these other IDs and PCGs and tax determinations that spell out how we need to look at hypothetical arrangements and other sorts of situations when determining whether something is arm's length. And the LCR really sort of honed in on these other tried and tested practices like off-market transfers and paying fund expenses and the performance of services, should you charge, shouldn't you charge, and really took these peripheral issues and turned them into major non-arm's length income issues. And that is, to me, quite troubling. And so, you know, I kind of think that the chain of events was that 2010 set this chain of events off with reference to the way the ID came out about borrowing on terms that are more favourable to the self-managed super fund. Clearly, in a SIS environment, that is fine. But that TR 2010 of what is a contribution and when is a contribution made, and then the SMSF 2010 about acquiring assets and the provision of services, inclusive of goods, to me, they were pretty critical in this whole non-arm's length income. And I'm going to come back and talk about them sort of shortly with regards to, I guess, the problems I see in some of the examples that have been raised in that situation. So when I get to that, we'll start to work through a couple more issues. But again, what I wanted to address was, as I start to talk through the LCR specifically, and therefore the PCG as a bit of a guiding light for us as well, I just want to spend 1 minute on the where we got to, or where we came from, and that is that we started out with the superannuation tax integrity measure document released by Treasury, and that's just one of about 3 documents that were provided. And a lot of this came out obviously pre-federal election. And I remember I was at the time I was helping the CAs plan their national SMSF conference, and I couldn't get anybody to talk about these new non-arm's length expense measures because they appeared to be so dull, right? It appeared to be a fairly minor inconvenience to the way the law was written, that there really wasn't an hour's worth of conversation. Well, jump 2 years and there's been hundreds of hours of presentations done on these sorts of things. And that's because from the very first exposure draft that was released to the final piece of legislation, we had this inclusion of our non-arm's length schemes and these internal arrangements. So this whole element about accounting fees and other fees where you're paying less than commercial or not paying them, and trustee versus individual capacity, none of that was even sort of thought about. It wasn't even in the thinking of the original legislation pre-federal election. Now, let's not suggest that that was deliberate and then it was put in afterwards once the government knew that they had the capacity to introduce the legislation, because both sides of the law of the Parliament were more than happy to introduce measures that increase tax for self-managed super funds, or targeted potentially self-managed super funds. But the fact that we went from not even being mentioned in the first document to being in a stage where it was introduced and effectively passed without a great deal of consultation because people didn't really know what it meant, that to me was a bit of a problem for something that was really addressed in these Treasury documents as an LRBA issue. And I think that's something that we need to be mindful of. So what I want to do is I do want to spend a little bit of time talking about the LCR and what that actually means, and then the impact measures that has with regards to our existing sort of SMSF practices, as I said before, and moving forward, our communication piece with our clients. So I know that we'll probably get some questions throughout here, and I'll chuck to Ben as we get them. So please, as I said, feel free to ask any questions as we go along, if you've got any scenarios. I know that we actually, and I'm very thankful, we did get a question before the presentation today, which was nice, and so I've incorporated that in, and Ben's going to shoot that at me because I can't remember what it is off the top of my head, so he'll shoot that to me shortly. But I guess the key measure of this LCR 2019 D3 was, it firstly requires us to identify a scheme. So it requires us to identify a scheme where the parties are not dealing with each other on an arm's length basis. So as I said before, a scheme is going to be any arrangement or any scheme, plan, proposal, action, course of conduct that the trustees enter into. So it's pretty much anything the trustee does is considered a scheme. It's a pretty nasty word, I find, for entering into a standard transaction, but it's something that we need to be mindful of. Now, if we're entering into or dealing in a scheme and we're not at arm's length, then, and the first part of the LCR, I think, gets it right. There must be, it talks about there being a sufficient nexus between the non-arm's length expense, so the associated expense of the investment, and the relevant ordinary or statutory income. So in producing capital, in producing income for the fund, if there's a nexus between a lower than commercial expense and the income that the fund produces, then you are tarnishing that investment with the non-arm's length income brush. And that is okay in the sense of if we're entering into some of these, say, discretionary trust transactions or even unit trust transactions where the trust is not paying for certain things, or somewhere along the lines the parties are undervaluing the expenses, and therefore we're overstating or over evaluating the income that the fund is receiving. But then the fact that the ruling goes on to talk about, in some instances, there's going to be a nexus between the expense and all of the income of the fund. That's obviously what caught everybody's attention and got our back up, particularly when they started to introduce the issue of administration and accounting type fees and what that actually meant, given that those fees have this nexus to all the income of the fund, which of course most of us would suggest otherwise. We would suggest that the accounting fees, the administration fees of the fund, actually have no nexus to the investment performance and the income produced by the superannuation fund. And then when you go one step further, and there's been a lot of attention provided to the SMSF expense ratio that the ATO have recently released and identified that ultimately the fund administration costs for self-managed super funds are on average about 0.05% of fund assets. So it represents a very small proportion of the overall fund expenses. And so then if you start to address that and say, well, how does that expense ratio really impact the overall income of the fund? You know, why is this all of a sudden such a big measure if we are trying to do the right thing by cutting our costs or saving our costs, or have parties willing for us to use their materials and other things without it being problematic or without it creating an issue? Why should those transactions impact the overall income of the fund? And so, you know, that the direction that the non-arm's length expenses ruling went to became pretty significant. And I'm going to come back and talk about the off-market transfer things and that in a moment. But I think from that pure costs and expenses directed or directly related to all income and having that nexus there, you know, I tried to identify and work through the list of parties that might be impacted. Clearly, administrators are one, and at the same level, fund accountants. So those that are preparing the financial statements for audit, then there is clearly an issue there. You'd assume that the audit fees are an area that is probably untouched. And I say probably because if we address all of the audit independent issues and other things that are going on now, then you've clearly got arm's length transactions occurring in the SMSF audit space. Now, that's not to suggest that there aren't non-arm's length transactions occurring, but it's fairly minimal compared to, say, the administrator / accountant who is preparing the books. And we'll work through a couple of those examples in a moment from the LCR. But if you go by extension to some of the other SMSF professionals that are impacted by this measure, then you've got your brokers. So if we're looking at discount brokerage fees, right? So if we've got discounted brokerage fees that the SMSF trustee, because they're also a broker, that they're obtaining to buy shares, well, all of a sudden, does that mean all of the income associated with those shares is non-arm's length income? That to me is, in theory, a long bow, but in the way that this document is worded, it's actually not that such a long bow to draw. And as such, we could find that, you know, these little ticky touch kind of investment expenses could become problematic. Advisors and the platform fees. And again, I know that platform fees, you've got the scope to discount platform fees. So what is the impact of providing discounted platform fees to your own self-managed super fund if it's to a greater level than what potentially you're providing to the other advisors? And, you know, I mean, do you see, Ben, this might be a very short answer, I don't know, but do you see differences in the platform fees that are charged amongst the clients that you get, or is it relatively uniform in that space?
It's pretty uniform, to be honest.
Yeah.
Obviously, a number of advisors have their own funds, but the fund expenditure is the same as just a client.
Okay, so look, that's probably a good thing in this regard, but I guess it's that you know, I used to also deal with group life insurance, and you know that that there was always the capacity to have commissions associated with insurance, and I know that often that, like for my fund at the time, we provided no commissions. And then for other funds, there were commissions associated with it. And so that could have been one of those areas that was problematic back in the day. So I think it's certainly something that we need to be mindful of. Property managers is definitely an issue if there are property management fees that people need to identify. And that was, of course, raised in the LCR. But to me, one of the bigger ones, of course, is how this is all going to impact building and construction. But I'm going to touch on that a little bit more when I talk about the contributions and remunerating trustee rules that we know are in place. So, you know, I've put question marks there because I suspect that there are a number of other areas that we need to be mindful of in this space. So the examples that were provided in the LCR of non-arm's length expenditure incurred has a nexus to all income of the fund, which would be non-arm's length income. And that was where Mikasa engages her accounting firm to provide accounting services for the fund at no cost. So she used all the accounting equipment, and that was considered to be non-arm's length income, versus the internal arrangement with an SMSF where the trustee provides the services to the fund, which was Leonie in this one, who's also an accountant, just like Mikasa, but uses her own equipment and doesn't charge her fund. This is okay and not a non-arm's length situation. So, you know, I fit very comfortably for myself in example 6 with my self-managed superannuation fund. I know that I prepare my returns and that at home. Hasn't always been the case, you know, potentially I should get someone more professional than myself to do the administration, but I seem to tick all the boxes there. But I know, Ben, that this is the one that I had the question that came through beforehand, and I thought, whilst it was slightly different to these two examples, I thought the concept was a really good conversation piece for us to discuss. So if you can just drag that question out for me, and we'll go through it.
Yep. So the question was, I have an accounting firm client where SMSF administration is done in combination with personal and business returns.
Yep.
And only one invoice is generated for a client's group of entities. Then the entity with the highest tax rate is in the group, pays the invoice in full, which is never the SMSF. What are your thoughts on this practice with respect to NALI?
Okay, so this is a really interesting one, and I know that Marion, who sent this through, said that she has advised the accounting firm that her feeling about this is that it's not the right way to transact, and that the fund should be paying for its preparation and lodgement of financial statements, and that to do otherwise would be considered non-arm's length, or potentially could be considered non-arm's length income. And I tend to agree with Marion on this one, because it's an awkward situation, because clearly the accounting firm is actually doing things at market value. So it's actually charging the fund or charging the entities at market value. But in many respects, it's sort of saying, well, what we're going to do is we're going to bundle everything together, and we're going to get a tax benefit, or give a tax benefit the highest taxpayer or the highest tax rate. And so I don't actually necessarily think that the problematic part of this is the accounting firm. I think that it's that the transaction is more favourable to the related entities. And so this transaction is being more favourable to, let's say, the related business or the individual personally who's on a higher marginal tax rate. And, you know, I suspect that this income is not even being brought up as a contribution for the fund. So then you would say, well, an invoice has actually been raised, and the invoice is identifying the work that's being performed on behalf of the self-managed superannuation fund. And so that expense to me should be met by the self-managed fund. And so I have a fundamental problem with it in that, you know, if you go back many years ago, a lot of people used to pay their actuarial fees personally because there was no tax benefit in the superannuation fund. There's no tax benefit to them either. There's no tax benefit to them in the fund because it was all exempt current pension income. But then, you know, the ATO, through this contribution ruling back in 2010, said, well, that is an expense that is borne out of the super fund. And if another party is paying that expense, then that should be treated as a contribution. Now, the fact is that they're in pension and many of those people couldn't contribute. So you created this dilemma of, well, how do you treat it? So, well, the only way to treat it is for the fund to pay it. So I think in this situation, in that example, clearly to me, the best course of action is to pay the expenses out of the super fund, given that they're already calculating it on an arm's length basis. So it's a difficult area to deal with, and obviously we don't have any certainty yet from the commissioner. Look, I'm never too how do I say this? Never too enthusiastic that you're going to get a positive response from the commissioner with regards to these sorts of questions. And, you know, I think I've been in the industry long enough to know that if you don't want to know the answer to a question, don't ask the tax office, or if you don't want to get a bad answer, don't ask the tax office, because I think the ATO, in many respects, with all of these rulings, and you look at TR 2010-1, SMSF ruling 2010-1, there's so many positive rulings out there that give us good enough direction, but then someone recognises something that's not in them and asks a question of the ATO, and it leads to a situation. And it's no doubt that these non-arm's length expenses issues have been introduced because someone's asked too many questions or somebody prodded the ATO too many times. I said, okay, well, we think this is an issue, and we're going to turn it into an issue. The same thing with SMSF reserves, you know, and defined benefit pensions and those sorts of issues. You know, the whole, should this amount be counted as an allocation or not? You know, the world was going along pretty nicely until somebody asked a question from a defined benefit point of view, and it changed the way we practice, and it changed the position of the ATO. So I think in many of these areas, we need to be mindful. And I think as I address these other considerations and start to talk about off-market transfers, I think that is certainly a space that we need to be mindful of. So for me, this whole non-arm's length income change up, and the whole concept around limited recourse borrowings and the the lower or underpayment of interest, to me was a little bit of a non-event. To me, we addressed that in 2010. We tightened it up in 2016. Yes, those gnarly provisions being brought in 2018 were probably the icing on the cake for limited recourse borrowing arrangements. But then the fact that it's now going to impact Section 17B of the SIS Act with our remuneration of trustees, it's going to impact what is a contribution for from TR 2010-1. It's going to impact the acquisition of assets from a related party rules, because all of these things put in place guidelines and boundaries for us to work on. And I actually can't see that these boundaries are being manipulated out there from an industry point of view. I would suspect that genuine errors have occurred. And I know with things like off-market transfers, processing issues are a major issue. But I think that there's this issue associated with these areas that 10 years of practice is very hard for us to turn around and immediately expect trustees to change the way they do things. And I think we need to be mindful of that these non-arm's length expenses are really more about communication to existing practices to make sure people understand the ramifications. And one thing I guess that we can say is that in some instances, there is no absolute answer, right? You know, you get clients like the discretionary trust one that you had before, Ben, where the answer is very simple. You've done the wrong thing, or not that it's wrong, but there's consequences for the transactions that you've undertaken. That is an SMSF that invests in a discretionary trust, even if it thought it was a unit trust, a fixed trust to start with, right? You've got to do your due diligence to make sure that it's not a discretionary trust, because that income will be non-arm's length income. It doesn't mean it's a non-compliant fund, it just means that it's non-arm's length income. So you've got to be mindful of that. The other thing associated with that is that it has references, historical references to non-concessional contributions and other things like that as well, if you're talking about allocations from a family trust and the like. So, you know, what relevance, or where do I see these rulings sitting in today's environment? Probably to give a bit of an example from them, and then I know that we've just had another question come through, but I'll go through these examples first, and then I'll get that question from you, Ben. From tax ruling 2010-1 on contributions, you know, the definition of contributions, it discussed that there's no contribution made by a free service. So Jasmine has a self-managed super fund of which she's a sole member, she's a CA. She prepares the accounts and income tax and regulatory return for her self-managed super fund each year without remuneration. By not incurring a liability, the capital of the fund is not increased. So that's okay. We all understand that is not a contribution. Now, if Jasmine prepared that at home, we would also be saying, okay, well, she's preparing it not in her capacity as a chartered accountant, but she's preparing it in her capacity as an SMSF trustee. But if she then goes and prepares that work using the resources of the chartered accounting firm that she works for, then all of a sudden she's not actually undertaking that work in her capacity as trustee, right? She's then undertaking that work in her capacity as an individual. The fund should be charged for it. The fund should be charged commercially for it. And therefore all of the income of the fund is going to be non-arm's length income. And that, to me, it takes us away from the idea of just assuming you can do things and there not being any expenses associated with it. And then if we jump over to SMSF ruling 2010 example 5, talking about the performance of a service with insignificant value, a member of an SMSF fixes taps in a rental property owned by the SMSF by replacing the tap washers. As the tap washers are insignificant in value and function, the substance of the transaction is the performance of a service, right? And so it's not considered the acquisition of an asset. Now, the next example in that ruling went on to talk about somebody replacing an air conditioning unit. And by chance, we've had that scenario here this year where one of our trustees is an air conditioning installer, and asked the question, so we're going to pay for the air conditioner, but do we have to pay for the labour? Now, this ruling had just come out, the LCR said, absolutely, you have to pay for the labour. So the fact that you're paying for the parts is one thing, but you have to pay for the labour as well. Otherwise, the expense is understated. And so it's certainly an area that we need to be mindful of, is that we've gone from this provision of service area, this provision of service situation, and now we're having to question whether or not the provision of that service is one that should be charged for because we're doing it in our individual capacity, or shouldn't be charged for because we're assuming that it's undertaken in our capacity as trustee. But then if that service is somehow linked to an asset of the fund, right? Now, fixing the taps is clearly associated, or an expense linked with an asset of the fund, so an investment of the fund. So by fixing the taps and replacing the washers, then have we incurred an expense? Have we incurred an expense or an outgoing, or have we not incurred an expense or an outgoing that's somehow related to a scheme between related parties? So me changing the washers in my investment property, in my self-managed super fund, am I implicating myself in non-arm's length income? Now, I don't think the LCR particularly answers that question. And I think it's an issue, I know from a consultation point of view, that we actually put a submission in to the draft, through the draft consultation period, to say, what about the property owner that paints the property? What about the property owner that fixes the fence line on the business real property, and they use their farming equipment because that's what they do? You know, I don't think those issues have been addressed, and I think it's a bit of a concern for the industry. But I think then the other part of it is, and I wanted to touch on, because I kind of highlighted there the property maintenance and the property improvements part. But to me, the key, or one of the key issues, is acquiring assets from a related party. And so I know that they talked about it in the ruling, but I also know, Ben, that we've got a question. So that's why I kind of was holding off on it, because I knew this slide was coming up. So if you can just sort of read that question out to me.
Yeah, so it says we have a client who wanted to arrange some share transfers via the broker during COVID office closure period. We prepared the off-market transfer forms and included consideration on the date as agreed with client. This was early June. The document was sent to the client, who signed and returned it in late June. The form was then lodged to the registry in early July. The client's intention was always to pay for these shares. However, the consideration wasn't paid until late July based on the early June amount. So what impact would the NALI provisions have on this transaction?
Right. Good question. Good question. So there's a couple of sticking points here. One point that I'd like to point out is that they paid for the shares, right? So that's not a unique set of circumstances, but often people will do off-market transfers and they'll do them as a contribution. I would think the payment of the shares is probably a secondary issue here. So I would think the fact that there's a late payment of the shares, and that's just almost failure to satisfy your, if you're doing your shares online, broker, whatever, then you've got your T+1 or T+3 or T+2, whatever the transactional period is where the money comes out of the account. This is effectively a failure to meet your contract obligations to pay. So I think that's a secondary issue. I think the bigger issue here is the consideration and the amount that they've actually paid. And so I think that's where the LCR has this issue where, let's say it was the 1st of June, we didn't have the actual days, but it was the 1st of June, and the price for those shares on that day was $10, right? $10 per share. And so the trustees have agreed to it, and they've signed the form, or sent the form out to be signed, and consideration $10, 1st of June, for however many shares. Then come later in the month, right, there's been a spike, and it wasn't unrealistic to see market improvements towards the end of the financial years. It often can be the case, and we know that they've improved since then as well. But you know, let's take a simple example for my own maths here, Ben. But the value of those shares on the 20th of June. So let's say they signed the forms on the 20th of June. Value of those shares was $15, right? So they paid $10 per share. The consideration for those shares, in actual fact, based on the ATO's position of when the share transfer takes effect, is the ATO's position is that share transaction takes effect on the 20th of June, right? So that's when the form is executed. So if they sign the form on the 20th of June, then that's when that transaction takes effect. Now, because they've acquired shares from a related party at market value, we have to assume market value. We would bring that in at $15. Right, so we should bring that transaction at $15. If they have only paid $10 per share, then we would naturally say, okay, well, you're going to need to treat the difference, that $5, as a contribution, right? Because if 20th of June is the date of change of beneficial ownership, which is when the form is executed, then we would try to clear that up and treat the difference, $5, as an off-market transfer. And that's basically what the SMSF, or the tax rule in 2010/1, provided us for what is a contribution. It's making up that difference there. So everything would then reflect what the SIS Act requires it to do. Under the non-arm's length income, right, expenses are saying that you haven't paid enough for those shares. So even though you've made up the difference as an off-market transfer, that still tarnishes those shares with non-arm's length expenses. Now, that to me is not what the intention of this legislation is about. That to me is taking a situation that has a solution, because we're not trying to bring something in undervalue and therefore generate greater income from the fund, because the law doesn't allow us to. Like the off-market transfer laws linked into the acquisition of asset by related parties and the contribution rulings doesn't allow us to undervalue that transaction. So just because we don't document something as a partial purchase and a partial contribution should not trigger non-arm's length income. But this ruling says that it does. And so we really need to make sure that we nail this off-market, no pun intended by the use of the word nail there, but this off-market transfer process, that we educate trustees that 10 years ago, the tax office finalised their position, which is the day that you sign the form, or the last person signs the form, is the day the valuation needs to be obtained for those shares. And so the time lapses that we're seeing are problematic. Now, the issue with that, and I'll keep this very short, but the issue with that is that what's the material issue, you know, with a dollar here or there, you know, if it's a small parcel of shares. And from an audit point of view, you're not going to get any material reporting or anything like that, because you've got your $30,000 5% sort of limitations with ACRs and things from the acquisition of asset rules and that. So it's not going to be a significant issue, but it's not going to take much for an auditor to highlight it, and therefore it be brought to the tax office attention, and therefore it lead down a path of non-arm's length income. And because the ATO's final position on that is that if they can't tell what date the shares are transferred, then it's the date of legal ownership, which was when the registry is done. So if that's in in July in that situation, then ultimately we're in a far worse position, because the shares have potentially doubled, or not doubled, but you know, they've gone up again in that period of time. So we need to be mindful of that. So, you know, I think it's a really good question to raise, and one that we need to make sure is identified in this space. So I see that the issues said the remuneration of trustees being critical in amongst all this, because it relates to duties or services other than their capacity as trustee. Trustees have to be appropriately qualified and licensed to perform the duties, and they're performing it in the ordinary course of business. And of course, the way the legislation of 17B is worded is that it's no more favourable to the trustee than if dealing on an arm's length basis. So therefore, if it is less favourable to the trustees, you know, is it going to potentially be a breach of 17B? The short answer to that might be no, but you then providing financial assistance to a related party, and so you create all these other potential leads and anomalies. So I think there are a lot of things that we need to be mindful of. And look, I've covered off on a lot of these issues as I've discussed through the presentation, and I touch on them again in the paper that I'll provide to everybody. But, you know, not only does non-arm's length expenses create taxing issues, then, you know, do people go the other way, and do people charge too much? Therefore, do we create financial assistance issues? Do we create issues which are cis arm's length issues? So, you know, we've got this whole area that we need to be mindful of when undertaking these practices. And of course, the link between COVID-19 and NALI, and this is really just a reminder that we have to be mindful that at some point rents have to start going back up, or to represent commercial rents, and particularly if we're dealing with related parties, we need to be on top of that as soon as we can. And the ATO have said that COVID won't be a trigger, or won't be a highlighted issue within the finalised LCR, but that doesn't mean it's going to be a compliance issue to not have to worry about moving forward. So I suspect as we move out of the let's call it the compliance shelter provided by COVID, the ATO may take a dim view on some of these issues. So what do we need to consider? Well, we need to consider how we handle our telephone conversations, because we need to change the way that we're talking with trustees these days. So when we're looking at from an accounting, from an admin point of view, but even from an advice point of view, what income items do we need to investigate further, like we did with the trust distributions there. But also, I think one of the key ones is what expenses don't we know about? And often that's the thing of being or having self-managed super funds is it's what you don't know that can harm you once somebody finds out, and we need to be mindful of that. So just to summarise all of those points, obviously we are awaiting the finalisation. Look, I'm not expecting it to be a pre-Christmas gift from the tax office. I'm not expecting it to be a gift at all from the tax office, actually, but let's hope that we see something early in the new calendar year so we can at least put it to bed, and anyone that's charging discount admin fees or accounting fees and those sorts of issues can start to think about it. The ATO have verbally indicated there will be a certain level of common sense. I'm always concerned when the ATO start to think about common sense because it seems to be less common than we think, their sense. But also we've had a change in commissioner, and that often brings a change in attitude. And so, we just get used to working with one party and then we're moving and working with another party. And we have to start the whole process all over again. If a business currently offers discounts to staff, then we need to act straight away. So if there's a change, or if the ruling is finalised as it currently says, then we need to be able to adapt our practices straight away. Otherwise, we've got potential for non-arm's length expenses. And always be recommending that all transactions are undertaken and maintained on commercial terms. So look, that brings us to the end of the presentation. Thanks all for attending and staying on board. Thank you all very much.